Hello friends, this is Gaurav Goyal from Lamuksh Investments. Today I'm going to talk about something which is very important for all fundamental investors. And this is important because we need to understand where we are in terms of valuations, where are we headed, and what is a good time to get into markets and possibly a great time to get out of the markets. And one such important ratio is to talk about the price to earning multiple, or what is popularly known as a PE ratio. So if we're talking of PE ratio, we see that P or price is the numerator and E or EPS, earning per share, is the denominator. Higher the P, higher the price to earning multiple, and higher the earning in the denominator, lower is the price to earning ratio. So when we talk of bull rallies in the market, as we are currently witnessing at this point of time, we see that we always would want uh, a PE, not a PE-led bull rally in the market, but an EPS-led bull rally in the market. So is this what is happening in Indian markets? Let's take a look at it. So let's consider Nifty 50. It's currently trading at about 17,800 level, 11 levels, which, if I consider the current level of earnings or EPS in the market, is it is at EPS is at around 720 levels, which makes our which gives us a price to earning multiple of around 24 levels. Now, if we is this 24 level a good number or a bad number or an average number? How do we make sense out of it? So let's rewind the clock a little bit. Last year, on March 31st, 2021, the same PE ratio was at 40. And if we take a closer look at the history of price to earning multiples of Nifty 50 in last 2 decades or 20 years, then we realize that highest it has touched was 40 last year and the lowest it has touched was 11. On an average, it has been in the range of 16 to 17. So when I say that we are currently at around 24 levels, are we expensive? Yes, we are expensive, but not as expensive as what we were last year when we were trading at 40 times price to earning multiple. We've come down by almost 16 points from 40 to currently 24 levels. Still makes us cheap, makes us expensive, but not as expensive. So what has contributed to this decline in price to earning multiple? And why I'm happy is because of the fact that it's not really only a price driven bull rally. It is also an earnings driven bull rally. And that makes it a lot more relevant and credible. So the Indian corporates have done exceptionally well in last 2 years, despite the fact that there was a second wave of corona last year, and towards the fag end of year of last year, we are, in fact, at this point of time, we are again witnessing possibly a third wave of COVID. Yet Indian corporates have done remarkably well. So the earnings per share in FY20, as I said, was FY 2021, I was at around 443 levels, and it was stagnant for previous few years. The year before that, it was at the same level. But this year, as I'm talking, it's at almost 720 levels. And it might end up at around 750, 770 levels by the end of this financial year, which is FY 21-22. So that makes me believe that yes, um, we are on a declining trend if the price remains stagnant, and makes us a lot more hopeful about the future. So when we talk of price to earning multiples, we always talk in terms of in terms of forward earnings, not really in terms of current earnings or the trailing earnings or the previous year earnings. And that is the reason for that is because markets are forward looking. So if we talk of FY 22-23, then we are possibly talking of another maybe 20% rise in EPS. This our personal assumption, and we believe that markets might Nifty 50 companies that are there in Nifty 50 might move up by the earnings per share of these 50 companies would go up by another 20% in FY 22-23. What this does for, if let us assume that markets don't move up and they stay where they are at 17,800 levels, and with an EPS of 870, which is a 20% rise from the current year earnings, that takes the P ratio to almost 20 levels. And so we're getting closer towards the historical averages. And extrapolating this further, if we take it to 23, 24, which is not really too much of an exaggeration. So if we go to 23, 24, which is a 2-year forward earning multiple, we are talking of a ratio which is in line with historical averages of about 16 to 17. Then what happens is it makes us in line with the historical averages and we don't remain expensive. Of course, price does not stay where we are, it's just an assumption. So, so let us try to draw a conclusion around this. And what I'm trying to say is that yes, uh, we are a little expensive, but we are not overly expensive. If somebody tells you, yes, we are just gone crazy and markets have moved up so much and let's get out of the markets, that's not the way to look at it. If you're willing to hold your investments for a longish period of time, as fundamental investors should do, then we are perhaps on the right track, and we should not worry too much about where we are headed in terms of markets going crazy. Okay. Just trying an analogy to this and look at perhaps the banking index also, where I have a slightly stronger conviction because in last 2 years, banking sector has actually underperformed most of the other indices, and public sector banks in particular have not done too well. Some of the private sector banks have also lagged or underperformed the broader set of companies in let's say Nifty or mid cap or small cap index. So where are we on the banking sector? In the banking sector, the valuations, the price to earning multiple is around the same levels currently at around 23. But you have to realize that banks have done a remarkable job in cleansing their book in last 2 years, and the price appreciation has not been so significant. There's much lighter in terms of the bad debts that they carry, uh, the loan growth that they've shown, and the profits that they've generated. So overall, I would say that banks which have largely traded at the P multiple, which is much higher than other indices, is currently either trading lower or in line with the let's say Nifty 50. So, which makes which makes my belief a lot more stronger that perhaps at some point of time, banking index will start moving up in a much more meaningful way than what we currently anticipate and give weightage to. So I think whether it's FY 22, FY 23, we might see a resurgence of banking sectors coming back in a big way. Um, just taking another step forward and look at the mid cap and the small cap index, where it is difficult to really analyze only on the basis of P ratio, largely because the universe is much, much bigger over there. And the quality of stock selection that you do over there makes it a lot more meaningful. Having said that, still, if we just try to draw some conclusions out of it, mid cap and small caps have done remarkably well in calendar year 2021. Um, small cap index has grown by almost 60%. Mid cap index has grown by almost 45%. The PE ratios are much higher at almost 35 and 30 levels on small cap and mid cap respectively. Yet, we feel that there could be potential over there largely because they have traded at much higher levels earlier, and earnings over there have been reasonably good as well, which makes it quite interesting. So overall, we remain bullish on all the indices. We feel that banking and Nifty 50 might do slightly better than small cap and mid cap sector, and where I also think that stock selection would be the key in mid and small cap sector, and they could be smart investors could pick smart companies and make a lot of money even now. This is what I wanted to share with you. A nugget of fundamental analysis, P/E ratio, but just don't take it in isolation. It has to be cumulative number of several other factors like price to book value, dividend yields, perhaps a lot of other things that goes into it before taking your calls. However, it's important to keep a track of P/E ratios. It's the most widely accepted ratio or an indicator across the globe. That is what I wanted to share with you. Hope you liked what I've said. If you have more queries regarding it, um, or you want some more data from my end, I can happily share that with you. Need more information, any feedback, so that we can make such discussions more lively, more enriching, and anything else that you would like to say, give feedback. I would really appreciate it. Thank you so much. I hope you liked it, and we'll stay in touch.